Alright guys, hope everything is going well for you today. We're going to give you guys another update of several stocks that I've been buying over the course of the month, and we'll kind of piggyback off of some of the positions that I talked about in my last video. But I think we have about 8 additional positions that we need to talk to, a couple of which are new positions. Actually, I think only one of them is a new position, and the other 7 I believe are just additions to positions that have been added to the portfolio. Granted, some of these positions are rather new, and so they're still somewhat immature with respect to how many shares that they have. But some of them are pretty large, and some of them I haven't added to since about 2014, 2015 timeframe. So I'm really excited to talk to you guys about it. So let's just hop right into it. So this video, I really just want to give you guys a brief overview. I know I didn't do this one on the previous video where I talked about 9 or so stocks that I've been buying in basically the first week of March. Now we're kind of entering the second week of March here, and we're ending rather the second week of March here, and have a couple more positions that I wanted to buy. So personally, put a decent amount in the S&P 500 yesterday at the close. So I put about $19,000 in the S&P 500 that was in my 401k. So I don't really track that too much, but you can see since I've been putting money, dipping money back into the 401k, the 401k has actually slightly come down. So I believe at the highest, the 401k got to about 130, 131,000. So I'm only down, 4% or so. So I can't complain about that. And I kind of have a strategy as to if the market continues to go down, how much I'm going to layer in. So a lot of this is currently cash. I think about 25,000 of it, no, more like 40,000 of it at this point is invested strictly in the S&P 500. So we have about $80,000 left that is strictly cash to be kind of deployed over time. But actually honing into the rest of the portfolio, we're down from all-time highs about $67,000. That's fine. Yesterday was, I believe, if you were to have looked at it before today's open, and I should have made a video about it, I was down over $80,000 or very close to. I think I was like 77 or almost 78,000, and that was before the 401k kind of refreshed. So the 401k went down about $2,000 to $3,000 yesterday. So if you add all that up, we were down over $80,000 yesterday, and we've kind of come up a little bit off of all-time lows in the portfolio since we've kind of broke over the $400,000 range. So been aggressively adding, and we'll kind of talk a little bit about this. You guys have probably been like, oh my God, this guy has shot up. So about a month or so ago, it was around $950 a month in dividend income. Now we're looking almost about $200 more than that. Recently deployed around $25,000 into the dividend portion of the portfolio. So that's that $244,000 you see here. Of course, this includes some losses as well. So, and I also readjusted this to include, some money that I had gotten rather recently. So basically put an additional $20,000 kind of in the cash position here, just kind of waiting. So you can see that the cash position of the portfolio has kind of grown a decent bit as well. But I've been continuing to deploy cash. So generally speaking, when I buy in the dividend portfolio, generally I'm buying about $5,000 to $6,000 or so every single time. And so you kind of see that when we get to the rest of the video here. But currently up to around $13,600, which is good enough for just over $1,100 a month, which is pretty cool. So that combined with YouTube income and combined with Shopify income, we're closing in on $2,000 a month, which is like my bare minimums that I would need to like live off of like peanut butter and jelly sandwiches and live in a bare bones apartment. Or I could live pretty lavishly on $2,000 a month if I were to say move to some of these other countries and do some expat arbitrage that some people talk about in the video. But before we jump into the actual stocks that I've been buying, so we do have some codes for you guys to get discounts if you want to manage your portfolio, kind of like what we have here. A lot of it's automated. I have a video for you guys in the description as well to kind of walk through how I made it. So you could actually use that video if you want to make your own spreadsheet, or you could just visit our website and download it from there. But we have some codes for you guys if you're interested. One will be 30% off. We still have one 30% off code that for some reason when we launched the Google Sheet nobody utilized. And then we're doing a code as well for the fact that we recently had a market crash, and some of you guys might be wanting to learn how to manage your portfolio in a time like this to kind of reallocate. So Yeah, let's hop into the actual stocks that I've been buying. And so, um, this is just kind of keeping track over the past 2 to 3 weeks or so of the purchases I've been buying. And so you can see that I mentioned that I purchased about $25,000 over the past 2 to 3 weeks. That's still true. Of that, we're down to like $19,000. So we are losing money on the purchases that we had done recently, which is fine with me. I know that happens, and I'm going to continue to be adding capital into the portfolio. But I'm not bothered by this. I think some people might be, and so just to acknowledge that, I'm fine with it. I understand that that's part of the market. One of the cool things I'd like to note is the value of these portfolios have gone down, but the dividend income is yet to be affected. That being said, none of the companies that I own have cut the dividend yet. I own higher quality oil and gas companies, so some people might be like, oh my God, this guy's invested in energy companies. So far, those energy companies, none of them have cut the dividend yet. I generally stay away from high debt ridden companies like Oxy. I know Apache just cut their dividend as well. Apache's relatively well run, but I believe they had a debt problem as well. So they continue to buy a bunch of different assets from a bunch of different companies, and nothing wrong with that, but they needed to get their debt in check. And so, unfortunately, to help their cash position, they're going to be cutting their dividend as well. So, just to be curious, and just so you guys know out there, these debt levels or these dividend levels are creeping up. So, just under 6% on the yield of the portfolio just from the last few positions that I purchased, but it's already crept up to just under 8%. And so what I'm saying here is make sure when you're buying some of these companies that some of them have risk. It's not going to be guaranteed that you're going to get that 8%. But anyway, just from these 2 weeks or so, 2 to 3 weeks or so, purchases of the $25,000 that I put in, I've increased basically the monthly income of the portfolio by about $1,500, or about $125 a single month, which is kind of cool. And that's based off of the $19,000 or so here. But like I mentioned, I'd put in about 25,000 of actual money into the portfolio. So these companies here are what I discussed a little bit last week. So most of these I purchased on the 9th, 4th, and the 27th of February. But going down here into the companies that I purchased mostly today on Friday the 13th, so it's either a good omen or a bad one, depending on how you look at it. Bought some Boeing. So I've never owned Boeing before. I wanted to buy some Boeing, and I've been looking at it since it dipped to $110 back in February of 2016. I remember that because I saw it a week or two later, and it had already been up into the 130s, 140s, and I was like, maybe it'll come back down. Sometimes these companies don't come back down. So that being said, this is about 60% down from its all-time highs. Let me just double check. It's 58% down from its all-time highs, or 52-week highs. So that also might be coming down just because it's been on a rough sort of past couple months as well. So figured I would dip my toes. 60% down. I mean, it's a great company. I know they're going through some issues with their engineering and trying to figure out what's necessarily going on there with their logistics. And that's fine. I've seen companies do this before, but they turn themselves around. Good quality companies turn themselves around. Companies with horrible cultures end up festering and kind of, getting infected and eventually just dying. And so, really am fine with owning Boeing at $160 a share. I think I bought it at $162 a share. I mean, considering it was trading upwards of close to $400, I'm fine dipping my toes in here. And if it continues to kind of hang around at this point, maybe I'll continue to add. Yield on cost for me is about 5%, which is kind of cool. Already up a couple percent on this position as well, but I'm not buying it for the capital gains, just buying it more so for the high quality dividends. Stag Industrial is a company I haven't been added to since about 2014 or 2015 timeframe. Threw about $500 at it. So pays once a month, every single month. Bought $21.50, which is about what my cost basis was beforehand. So I figured, hey, it's been 4 or 5 years. It's a great company. It's been paying me, has had zero issues. The yield actually has gone up since I purchased it. Got myself about a 6.7 yield on cost, which is pretty cool, and it's already dipping down closer to the low sixes here. So up a little bit from this position, which is fine. I'd be happy buying this company. up to about 23, $24, which is why I haven't bought it for such a long time. It's been trading above 30 bucks or so for quite some time. This one traded up about 33, it looks like here, and it's down 30%. So can't argue with that. I figured I would buy it. Granted, it's not in the 401k, which kind of has me a little bit upset here. Or not 401k, but the IRA, which has me a little bit upset because obviously I don't get the tax benefits and it's a real estate investment trust. So I might have to pay a little bit more taxes on it, but it's fine compared to, some of the other positions that I wanted to open up. Really wanted to add myself to Stag. I think warehouses are not going away. I think they're only going to get exacerbated as people continue to online shop. Um, so yeah, that's my kind of quick thesis on Stag Industrial. GEO Group is a prison real estate investment trust. My buddy Kyle from Passive Income Investor talks about it a good bit. So, I'll let him, kind of talk to you about that one. But recently, I think as of last week, this was trading in the $16 range. And so I think earlier this week, it had a little bit of trouble, dipped down to the 11.75 range. And so I said, hey, I'm going to pull the trigger on that. Yield of about 16%, has the cash flows to keep paying out. So unless people reinvest the dividends and the share count kind of explodes and they can't keep up with the amount of dividends they're paying, I think they're able to pay it, and I don't have any problems with it. It looks like a pretty well-run company, and it really only looks to be in a position like this because obviously the recent turmoil that's going on in the markets, but also just who we have in the potential elections that are coming up in 2020. As it is, all-time highs here, it's down 50% or so from all-time highs, about $24. Wow. So over the past year, it's about $24. But I know it's been channeling on a downward trend for quite some time as well. But like I said, Kyle, Passive Income Investor, has the situation for you there if you're interested. Bank of Nova Scotia, couldn't pass by this one. I think I initially added to BNS. I have 100 shares or so. I think I added about 56 bucks or so. And so we're down from that. Figured I would add myself. We're down from an all-time high of about 58. So we're down just over 30%, or just under 30% rather, and purchased my shares, 37 of them, for about 40 bucks. So can't complain with that. It's a pretty good yield, up in the mid sixes here. And so you can still purchase this one for relatively cheap. Caterpillar is one I've been slowly trying to accumulate. I purchased this, I believe, last week as well. So this one is kind of the only redundant one out of the group that I purchased last week as well. Purchased another 16 shares for 1,500 bucks, of which it's about $93.20. That's down $13 a share compared to what I purchased it last week. So slowly accumulating more and more shares of Caterpillar, and it's yielding above 4%, which for Caterpillar is pretty wild. So I'm all about it. It's going to end up paying me another 60 bucks or so a year. So just in the purchases that I made here over the past 2 weeks, we have Caterpillar at 66 bucks. We have Caterpillar at 58 bucks. So that combination pays me about another $10 a year, or $10 a month rather, just from these two ads over the past 2 weeks here. So pretty excited about that one. KMI, purchased some Robinhood shares, 1 share of Kinder Morgan, 6 shares of GM, 2 shares of Southern Company. And that was really to just, get $250 out. I had $250 that apparently I guess is coming on Monday. I have it coming in mid-month and the first of the month. And so I said, hey, I don't know if I could wait. So I added 250 bucks, manually, and added it in there. And Kinder Morgan's down. I think I've been purchasing it around 20 bucks or so in my individual brokerage account. And I purchased that quite some time ago. But this one's down to 14. I know it's a well-run company, has a decent amount of distributable cash flow. So I figured, hey, good purchase. GM is one I think I'm going to hold for the long term based off of their new electric lineup that they're going to be bringing out and trying to challenge Tesla with. And so really curious how that goes. And I think it'll be a good purchase for the long term if you kind of want a contrarian view to Tesla. I think that GM is going to do well. They're going to bring back brands like the Hummer, Tahoe, Suburban, the Sierra, those kind of cars that really, have been around for quite some time. I come from a GM family. We generally buy GM cars. And so, I recently had a a Chevy Avalanche that I drove for quite some time. So if I could buy a GM product that's a fully electric, I mean, I'm definitely going to go with that rather than Tesla. Not that I'm saying Tesla's a bad vehicle. In fact, I know it's a phenomenal vehicle, but I think it's just how I grew up, and the GMs is something that I always grew up with, and kind of like growing up in a house with maybe with being on the right or the left. You kind of stick with what you grew up with sometimes, and so GM is just one of those things that always looking forward to seeing kind of come electric. And here it is. It's going to be starting with a lot of Cadillacs, and I love Cadillacs. I remember seeing like old 50s Cadillacs with my dad at car shows, and so that sort of stuff, kind of gets you a bias to want to buy something that's like a GM, you know. And like I said, nothing wrong with Tesla. They're a great company, but I think that GM has a good second footing as a potential second American electric car maker. And I think they're on the verge of having some pretty exponential growth in that particular market, and potentially stealing away regular naturally aspirated market. Third company in the Robinhood purchase here was 2 shares of Southern Company. So started purchasing Southern Company just below $70 a share, and I believe Southern Company is one of those companies that's really trying to get their wind and solar electricity up. And so, that being said, I really, really, really want to continue to purchase Southern Company for the long term. Has a really good price to earnings ratio, so I know they're making good cash. Their yield on cost was in the mid fours, which is pretty unheard of for Southern Company, believe it or not. Even though it's a utility stock, generally this one trades at a pretty good premium. It's one of the oldest ones. It's, I think, from Georgia. But regardless, has been a really well-run company for quite some time. If you're able to purchase in, basically get it down to 52-week lows, I believe, I would purchase it for sure. I don't think that this $51 is where it was due to this price dip that we're seeing here. I think it's just that's how much the company has grown over the past 6 months or so. But you can see just from here, we're off about 27% from all-time highs at $71. So you're getting it at a pretty good discount, almost close to the 52-week low. We're only up about 4% from the 52-week low. So if we go any lower in Southern Company, we're going to be breaking into new lows. And I think that it's kind of channeled between the $40 to $50 range for a couple of years before it went on this large tear over the past 365 days or so. So if you're able to pick it up at this kind of price, you'll be looking pretty good. Going into what the actual by sector view looks like, so let's scroll over here. Still a decent amount coming from energy. So 36 or so, or over a third of the money that I went into the portfolio is in energy. Now, of course, this is also being said, this is the current value, so it could actually be a little bit higher. Income-wise, we're over half of the money or income coming from energy stocks. Financials is about 20% of the income. Real estate's about 7.5%. Industrials is something I definitely have been wanting to add to, and you can see from the capital they've been adding, it's around 27% of what the value of the companies are now. So of course this could have gone up a little bit. And materials added up a little bit. So nothing too crazy, but I'd say the largest ones that I was definitely attacking for sure were energy, real estate, industrials, and financials. And so I definitely think I made my point in that, and was able to definitely get those up. Individual brokerage account, you can see, is where I've been spending most of my money. So these graphs on the left and right, the value and the income on the left, value on the right, it's about equal. So you don't really have to do too much looking and seeing, how much does it differ. So individual brokerage accounts are about 3/4 of the value and income of the positions that I've been adding at the moment. Computer shares is about the next biggest at about 20% on the right for value, and 22% in terms of income. And that was from Exxon being added in the computer shares account. YouTube Moolah added, just some cash going in. So nothing too crazy there. And the Roth IRA. So this doesn't necessarily keep in mind, this doesn't necessarily consider new contributions. Some of this could have come from cash. So some of this $25,000 was in cash before. So this doesn't include some of the offset associated with that. So yes, Some of the cash may have been generating income about 1.5 to 2% in terms of dividend yield over the year. So this $1,500 doesn't include that. And so when you actually convert this back to what we're looking at in the broader portfolio, it doesn't actually show that broader portfolio actually shows the impacts of losing that money. Whereas this is strictly looking at the positions that I've added to. So it doesn't include the cash outflow to purchase these shares. Looking again at the monthly totals that we'll be looking at for 2021, of course. So like I mentioned, we're up to about $1,500 or so in terms of monthly or yearly income coming from the positions we just discussed, most of which are going to be in the third month of every single quarter. So your March, your June, your September, and your December. So almost getting ourselves up another $300 or so. So wouldn't be surprised if some of these months in the coming future are up to around $2,000 a month. That being said, it's generally $30 to $50 or so in the first month and the second month of every quarter. So all these were quarterly payments. So none of them were like semi-annual or like annual dividend payments. One was a monthly payment, so we don't necessarily have to worry too much about that one. But interesting, continues to exacerbate the difference in the monthly income that we're seeing. So let's just gotta go to the monthly dividend analysis. You can see now that we're really still continuing to add to the yellow lines here, the third quarter or the third month of every single quarter. But you can see it's a nice stair step. So first month is still the lowest, of course. Second month is the second highest, and then of course the highest is the third month of every single quarter. So looking at the year-over-year growth that we're seeing at the moment, we got ourselves, it looks like here, 16% for February, 14% for March already, and January only up about 4.5% here. So I'm expecting to try to get this up a decent bit here. We're almost at the goal for 2021 if you were to look at it. The goal that we have here, I think I don't have it set it up in here yet, do I? I do. So the goal was to get ourselves to about $14,000 or so. We're at about 13 or so. Maybe this isn't entirely working at the moment. So this says 13.6. The other thing says 13.2. So I got to figure out what's going on with that. But the goal is to get to 14,000, but that's in 2020. So at the moment, if you were to look at what we're looking at for 2020, we are currently at about 13,200. Oh, okay. So that 2020 is this the 13,200. So that is correct. So this is correct here. This 13,200 is what we're expecting at the moment in 2020. The goal is to get to 14,000. So we're $800 away. That's bearing any sort of dividend cuts or anything like that. Hopefully we get some dividend raises. I will be reinvesting a lot of these dividends as well. But it just goes to show that we need an additional $6,000 or so of capital added to the portfolio to be able to kind of meet our goal. That, of course, is using the dividend yield that we have in the portfolio. That being said, the portfolio yield has kind of been creeping up. You can see, I believe, not too long ago, this is about 1.5% lower than what it was now. I think we're creeping at the 4.2, 4.3% for the dividend yield range, and I was trying to trend it a little bit lower as prices were going up. Now that prices have kind of shot down, the dividend yield of these companies has kind of come down as well. So if we average this 5.5 yield, of course, it's going to be real simple to be able to get ourselves to the $14,000 a year range. And of course, some of these companies are on sale, so it might be a little bit easier than I think. But I'm not necessarily going for yield per se. I'm going for steady dividend payments. And so, if I see a company that's paying 3.5%, 4%, say like a Caterpillar, I'm going to preferentially put my money into a Caterpillar, which I know is a high quality company that at the moment is kind of out of favor based off of market conditions. And instead of going into some really high risk company that pays like a 10-12% dividend that might get cut, you know what I mean? So just use your genius, use your thought, put some work into it. Any work that you put into learning, gaining the portfolio into a better position, and balancing and polishing the portfolio, the only smarter you're going to get over time And the more you feed the portfolio, of course, the more dividends it's going to feed you over time as well. You can't just expect to put $1,000 in and expect to get $1,000 out on a monthly, quarterly, or even annual basis unless you continue to feed the beast, right? It's like having a kid. It's like going to work. And unless you put more work into it, it's going to be pretty difficult to get past any sort of above average return. And if you don't feed the beast or put in monthly contributions month after month, I mean, don't expect above average sort of income coming from the portfolio unless you have some sort of crazy, income job. But anyway, hope that one was a pretty good video for you guys. Any questions, leave them down in the comment section down below. Hope this finds you guys great. Expect a decent amount more content from me. I will be able to save myself a morning and afternoon commute as I will be working from home for the next month or so. Just got the news this morning that parts of Trinidad and Tobago, some of the company is shutting down. So obviously safety critical and safety critical jobs will continue as planned, but work jobs that can be performed safely at home will be performed safely at home. So that gives me another hour in the day or so, and also potentially some time getting ready as well. So that gives me another hour to get ourselves some content. So hopefully I'm able to consistently put out the content that you guys are enjoying, and don't skip any days. I know this one I've been trying to do every other day for the past couple days, or the past couple videos, and it's worked out really well. The response has been really great, so I appreciate that. But that being said, I missed yesterday. So yesterday is when I was actually supposed to put out a video. But I'm giving you guys one on Friday the 13th, which is probably better because I purchased a lot of stock today. So thanks, guys. I'll talk to you guys on the next video. Cheers.